Last time, we made a video where we traded Forex using a hedging strategy that we purchased from some Forex trading guru who claims that it works all the time. Back then, we used it to trade Forex, and we've made some profit. I was extremely skeptical about it, but as usual, the best way to know whether a trading strategy is successful or not is backtesting. And that's what we're going to do today, using an expert advisor to get the most accurate results. With that being said, let's get into it. As usual, we'll begin by describing this strategy with some examples, then backtest it, and finally analyze the results. There are plenty of so-called Forex gurus who are selling strategies and signals, but it's important to be skeptical all the time. I mean, if you find a strategy that works all the time, would you share it with others? I'll let you think about it. So hedging is a strategy used to protect one's position in a currency pair from an adverse move. It's typically a form of short-term protection when a trader is concerned about news or an event triggering volatility in currency markets. Hedging in the Forex market is the process of protecting a position in a currency pair from the risk of losses. There are two types of hedging: direct and indirect. The direct hedging strategy consists of taking a position opposite in the same currency pair. For instance, if an investor goes long on Euro-USD, they short the same amount while waiting for the trend to develop. Once developed, the trader begins reducing the volume of the losing position and increases the volume towards the direction of the trend. And that's pretty much what we'll be doing today. The second method is known as indirect hedging strategy, which is similar to the first method, except that you trade two currency pairs with a strong negative correlation. Let's say you go long on the Aussie dollar and short on gold, which will allow you to reduce the risk of high market volatility. This is an interesting strategy that we'll discuss soon on this channel. With that out of the way, let's review the hedging strategy again. We first choose a currency pair with high volatility. Then we place two pending buy and sell stop orders, which are 10 pips away from each other. We'll aim for 150 pips profit in both cases. Let's say if the buy stop order is triggered and the price continues its uptrend and hits the take profit, we close all the orders and exit the market. But what happens if the buy order is triggered and the price goes down? In this case, we update the volume size of the sell stop order, so if the second take profit is hit, we close the two orders and exit with profit. To sum up, we'll be opening orders in both directions with a higher volume each time until we exit the whole setup with a profit. The expert advisor will calculate and update the volumes automatically. To make this feasible, we're going to use our recommended low spread broker. I'll leave a link in the description for those who are looking for a Tier 1 regulated Forex broker. Other than that, to avoid rollovers, we can choose a pair with a positive swap or simply close our positions before the end of the trading day. In the previous two videos, we've tested this strategy in live market conditions and exited with some profit. But today, we'll be using an expert advisor which will give us more accurate results. This is our expert advisor. We'll begin with the Euro-USD pair. The time frame doesn't matter here, as this hedging trading strategy is price-based. For the time interval, I'm going to choose 1 year. Regarding the initial balance, let's use $1,000. Regarding the other settings, we'll adjust them according to the strategy we discussed earlier. I'm thinking to try this strategy during the Asian market, which is considered the prime time of the day, though it's frequently ignored, as it's not volatile and liquid compared to other significant trading sessions. Its unique characteristics tend to attract scalpers. We'll run this strategy 24/7 this time. Let me know in the comments section if you're interested in any specific market session. Let's double check everything again, then hit on start. The process would take a couple of minutes. While waiting, don't forget to subscribe if this is your first time here, and hit on the thumbs up for the YouTube algorithm. Hedging is a very sophisticated trading strategy that can make you a successful trader if you master it. The rest is all about protecting your initial balance. The hedging trading strategy we are reviewing today is extremely basic, and it doesn't take into consideration elements such as fundamentals, which is a factor that has strong importance in Forex trading. We demonstrated that when we backtested the so-called 100% no-loss trading strategy. You can always submit your trading strategy if you want us to give it a shot. we'll either trade it manually or use an expert advisor. Let's look at the results now. We can see that we've lost a big portion of our initial balance. We recorded a significant drop in terms of equity in these two periods. By looking at this graph, we can also notice that the successful trades didn't contribute much in covering the losing ones. Right after this, we'll redo the same test with an increased take profit level to compare the final results. We've had a total of 536 trades, and the drawdown is 19.36%, which is high actually, but we can notice that the success rate is 67.35%. The number of successful trades is higher than the losing ones. This confirms what we noticed earlier when we saw the equity graph. What if we do another round of backtesting, but instead of aiming for a 15 pips take profit, we'll opt for a higher risk-to-reward ratio this time? We'll position our take profit level 60 pips away from the entry. Let's make the necessary changes to the expert advisor settings and run the backtesting process again. The other preferences remain the same. Once done, we can hit on Start. It's important to backtest any strategy multiple times using different settings. The most crucial element for any trading strategy is protecting your trading capital. Saving enough money to fund a trading account takes a great deal of time and effort. It can be even more difficult if you have to do it twice. It's necessary to note that protecting your trading capital is not synonymous with never experiencing a losing trade. All traders have losing positions. Protecting capital entails not taking unnecessary risks and doing everything you can to preserve your trading account. Great, we've just completed the process. We can see that we didn't lose our balance this time. When we check the graph section, we can find two lines. The blue one represents the real-time balance, and the green is for the actual balance. When you're backtesting a strategy, it's important to monitor the real-time balance. We can see that we ended up making some profit at the end of the day. We can notice an important drawdown here where the real-time balance dropped by 50%. But the hedging strategy was able to put us on track again, and we exited the setup with some profit. The total number of trades this time is 156. The success rate is 56.41%. The drawdown is almost 25%, which is extremely high, and the number of winning trades is higher than the losing ones. We've made a profit of $110 and grew our trading account by 11%. The successful trades were able to compensate for the amount of money lost in the losing ones. But does that make it a safe trading strategy? Choosing the wrong broker or forex pair could make this strategy extremely risky. But if we're stuck in a never-ending consolidation phase, that will consume a big portion of our capital, and we might end up in the situation where we don't have enough balance to open new trades. I believe that this strategy is a bit risky, but it will perform perfectly in a trending market. Let's say during the London or New York market opening. What do you think about this strategy? Let us know in the comments section. At this stage, it's important to review the losing trades to evaluate the true potential of this strategy, and that's what we're going to do next. Happy trading!